Welcome to the Deep Dive. We take your sources, articles, research notes, and really boil them down to what matters. Today, we're diving deep into something that, well, it affects all of us, really, whether you're actively investing or just managing savings. It's the huge and often surprising role human emotion plays in financial markets. It's not just about the numbers, it's about us, people. Okay, let's unpack this.
Yeah, it's absolutely key, isn't it? Because look, understanding how emotions kind of rise and fall in the market, that's not just like a side topic. It's honestly as crucial as getting the numbers on a balance sheet right. This dive today, I think it'll really show you the incredible power, sometimes strange power, human emotion has. It shapes markets, sure, but also our collective financial future.
Right, and to really get a feel for this, let's maybe go back to March 2020, that month.
Yeah.
Wow, it's definitely etched into financial history. You remember, streets just emptied out, like overnight, schools shut down, and there was just this heavy feeling, this uncertainty hanging over everything. What happened in the markets right then?
Oh, the reaction was instant and incredibly visceral is the word. Markets just flashed red, alarming red, sent shockwaves, didn't it, through the whole global economy. And it caused this, well, widespread panic. People weren't just thinking about selling, they were rushing to sell investments. Terrified, their savings would just poof, vanish. It was raw fear, unfiltered, like a stampede, really, driven by that awful thought of losing it all.
And it's fascinating, isn't it, how quickly that kind of primal fear can just hijack rational thinking. It showed us, plain as day, how markets are, deep down, powered by human feelings. Investors weren't just looking at data points. They were imagining, the worst possible outcomes, letting anxiety spiral and, kind of fueling that very decline they feared.
A self-fulfilling thing. Exactly. It became this awful cycle, this downward spiral. The more people sold, the faster prices fell. And it felt, in that moment, like it was impossible to stop. Looking back now, yeah, okay, it was an extreme emotional reaction, a collective panic, really. But here's the thing, markets did recover eventually, and they rewarded those who somehow managed to hold on, resist that massive urge to sell. It really tells you something. In those chaotic moments, logic. It's not just hard to find, it's a luxury, something few could really afford or even think about.
So March 2020, it wasn't just a market blip based on news. It was a genuine crisis of confidence, a huge lesson, really, in how fear and anxiety can move money way faster and sometimes way more irrationally than any headline. And that brings us neatly to those two big forces, yeah? Fear and greed, always there, like two sides of a coin.
They absolutely are. Think of greed as the market's accelerator. It pushes us to want more, chase bigger returns, and crucially, take on perhaps more risk than we should. Fear, though, that's the brake. That instinct telling us sell, protect yourself, get out.
And they have a direct impact, right? You see it in market behavior. Greed fuels those bubbles.
Yeah.
Prices shoot way past actual value. And fear, that causes the crashes, the frantic selling, the panic.
Which is exactly why getting a handle on these emotions helps us, navigate the markets. They're just fundamental to how we invest, how we react to people, often overriding the smartest models.
Talking about fear, let's dig into one specific type. FOMO, fear of missing out. It's not just jargon, is it? It's a seriously powerful force, drives a lot of behavior, especially in finance. It's that anxious feeling, and you think, oh no, am I missing out on this huge opportunity everyone else is jumping on?
Oh, it's so relatable. We've all felt it probably. Like imagine you're with friends, right? And they're all talking about some tech stock that's just going through the roof. Their excitement, it's infectious. Suddenly you're not thinking about your plan. You just feel this pull to rush in, buy it too.
Yeah.
Often without any real research, just so you're not the odd one out, the one who missed the boat.
Exactly. FOMO isn't about logic or careful thinking. It's pure emotion. That need to belong, the fear of being left out of the winner's circle.
Yeah, and think back to the dot-com boom. That's a classic example. So many people threw money at companies with zero profits, sometimes not even a clear business plan. Why? Just because everyone else was doing it and prices were soaring. FOMO pushes us to buy high, basically, swept up in hype, not fundamentals. It's that greater fool theory in action, isn't it? Hoping someone even more foolish will buy it off you later for even more risky business.
It really plays on our basic social nature, though. We're wired to follow the herd. We think there's safety in numbers. But in investing, that instinct can lead you way off track. I mean, following the crowd usually means buying when excitement is peaking high prices and selling when panic hits low prices. That's an expensive habit.
Which is why resisting FOMO, it's such a critical skill for investors. Seriously vital. It takes real discipline, sticking to your strategy when it feels like everyone else is getting rich quick overnight. It boils down to making informed, rational choices. based on research, your goals, not just reacting emotionally to the noise.
So these powerful emotions, they really drive those dramatic swings we see, don't they? The market's sort of two personalities, the crazy highs of bubbles and then the terrifying lows of crashes.
They absolutely do. Take a bubble. That's greed taking over. Creates this party atmosphere almost. Everyone feels like a genius, like a winner. Excitement spreads like wildfire. Optimism just hangs in the air. Asset prices soar, driven by stories, overnight millionaires, and this belief it'll just go on forever. People start justifying insane prices, ignoring the warning signs, dismissing anyone who doubts it. Rational thought takes a back seat. The crowd's just chasing higher and higher returns, and the media often jumps in, amplifying it all, creates this feedback loop. Greed, euphoria, more greed.
But then, boom, the mood shifts, sometimes really fast. That party feeling vanishes, fear muscles in, and suddenly it's all anxiety.
And that's the crash, a frantic scramble for the exits, driven by pure fear, uncertainty. Panic spreads incredibly quickly, everyone trying to sell all at once. Optimism, gone. Instantly replaced by doom, gloom, sheer panic. People start selling at any price they can get. Logic, reason, out the window. Just this overwhelming urge to escape losses. And like we saw in 2020, falling prices just feed the fear, pushing prices lower still as more people desperately try to sell. A vicious cycle.
The speed difference always gets me. Crashes are just so much faster, more violent. Something that took years to build up can just, poof, unravel in days. Or even hours sometimes.
It's a really important point because understanding these cycles, how they inflate and then burst, helps us navigate things more wisely. Spotting the signs early, that can make a huge difference. Helps you stay rational when emotions are swirling and the crowd's stampeding one way. Bubbles and crashes, they really lay bare the incredible power fear and greed have over markets, often much more than facts or fundamentals.
Okay, so it seems pretty clear then. High emotions, they often lead straight to financial mistakes, right?
Oh, absolutely. We see the same patterns again and again. When greed takes hold, people chase hot tips. They're basically gambling. They pile into whatever sector is booming. Feels great for a bit, maybe, but it leaves them massively exposed, overconcentrated. That diversification rule, forgotten. Greed makes you forget. Then fear kicks in, panic selling, turning paper losses into real, permanent ones. Because when markets eventually bounce back, and they usually do, those who sold at the bottom, they've locked in those losses for good. Fear can also just freeze you up. Paralysis. People avoid investing altogether. And sure, cash feels safe, but inflation, it silently eats away at its value over time. So avoiding market risk can actually lead to losing purchasing power long term.
So just understanding these common traps, these emotional pitfalls, that's half the battle, really. Learning from history, seeing the patterns, and trying hard not to repeat them ourselves. Which leads to the big question. How do we actually master these emotions? Because successful investing, it turns out, isn't really about frantic buying and selling. It's more about temperament, staying calm. I like the analogy of piloting a ship through a storm. A calm captain trusts the ship, knows the route, and stays the course. Doesn't just react to every wave.
That's a great analogy. Emotional control isn't just helpful, it's fundamental. It's what lets you actually stick to your financial plan, stops you chasing bubbles when greed is everywhere, and protects you from panic selling when things look grim. You have to accept that volatility is normal. It's part of how markets work, not necessarily a sign the world is ending. Mastering your emotions, truly, is key to long-term success.
And maybe the most important tool for staying calm, for investing rationally, is something pretty straightforward. Having a written plan. It's like your shield, your defense against the market's emotional storms.
It really is your compass. A good plan spells out your goals, and critically, your actual tolerance for risk. Not what you think it is, but what it really is. Money you need soon. That belongs in safer places. Money for the long haul. That can afford to ride out the market's ups and downs. Your plan should fit you, your personality, your situation. It outlines your strategy, diversification, all that. And importantly, it involves regular reviews, maybe annually, not checking your phone every 5 minutes for price changes. It's your commitment to act deliberately based on the plan, not just react emotionally to the noise.
Okay, so the plan is central. Are there other sort of practical things people can do, strategies to manage the emotions, tune out the noise, like maybe just checking your portfolio less often?
Definitely. Checking less often is huge. It reduces the temptation to tinker, to react impulsively. Out of sight, out of mind helps a lot. Another really good one is automating your investing. Set up those regular automatic contributions. It takes the decision-making stress out of it. You just keep investing consistently through thick and thin without having to think about timing. Also keep learning. Educate yourself about long-term investing principles, market history, not just today's headlines. Knowledge gives you context. Context reduces fear. And look, if you really have that itch to speculate, maybe set aside a tiny amount, a mad money account, clearly defined, small percentage. It lets you scratch that itch without derailing your main, serious, long-term plan. Yeah.
Those are great practical tips, things you can actually do. It's all about keeping emotions from driving the bus, right? Making sure your decisions stay rational, even when the market's going wild. Stay informed, yes, but stay disciplined above all. Managing our emotions lets us invest wisely. Okay, so as we wrap up this deep dive, let's remember, financial markets are always going to be emotional roller coasters. That's just their nature, fear and greed. They're not going away. They're fundamental drivers of market cycles.
Right. So the goal isn't to predict the market or control it. You can't. The goal is to learn to make your decisions using logic, not raw emotion. It really comes down to controlling your own behavior, sticking to a sensible plan through good times and bad.
And just think back to March 2021 last time. As scary as that felt, it showed the power, the long-term reward of staying calm. It's tough to remember in the moment, but opportunities often show up exactly when pessimism is at its absolute peak.
At the end of the day, your emotional state. That's either your greatest asset as an investor or your biggest liability.
So next time the market gets choppy, take a step back, breathe, look at your plan, invest with your head, not just your gut feelings, and you'll be setting yourself up for a much more secure financial future.